Hey everyone, welcome back to Financial Futures. In today's video, we have some exciting updates about SSDI and SSI that were recently announced by Social Security. I've got all the details right here, so let's dive in and discuss what's going on. First off, thank you so much for liking and sharing this video with those buttons right down below. I really appreciate your support. Also, if you're new here or if you haven't done so yet, welcome and thank you for watching. Please make sure to subscribe to the channel by hitting the subscribe button right down below. Again, thank you so much, I really appreciate it. Let's talk about the two major changes to SSDI and SSI that were recently announced by Social Security. These changes are actually very positive for the programs going forward. Just a quick reminder. Everything I'm discussing in this video pertains to SSDI and SSI benefits. Both of these programs are administered by the Social Security Administration and focus on people with limited income, limited resources, and disabilities. I want to make it very clear that the changes I'm discussing do not pertain to Social Security retirement, spousal benefits, survivors' benefits, or any other program. This video is specifically about SSDI and SSI. Although these programs are similar in many ways, they also have significant differences. The changes announced impact both benefit programs, so let's get into the details. When you go through the process of getting SSDI and SSI benefits, it's often not a pleasant experience. Many people face delays, back and forth paperwork, legal representation, and years of waiting. It's a massive headache for many, but recently announced changes aim to make the process a bit easier. Change number 1, the Dictionary of Occupational Titles, DOT, has been updated. What is the DOT? It's a comprehensive list of thousands of different occupations. When reviewing applications, the Social Security Administration uses this dictionary to see if there are any jobs you could potentially do despite your disability. They revised the dictionary and removed 114 occupations that no longer exist or are in very limited supply across the country. Some of these removed occupations include canary breeder, reptile farmer, nut sorter, watch repairer, and pneumatic tube operator. By removing these outdated titles, they can no longer deny claims based on these obsolete jobs. This change went into effect on June 22, so it's already helping applicants. Change number 2, the look-back period for work history has been reduced from 15 years to 5 years. Previously, the Social Security Administration would look back 15 years to see what kind of work you did, which they could use to deny benefits by suggesting you could still do similar work. Now, they only look back 5 years, which is a significant improvement. How many of us can remember what we did 15 years ago? Most people don't. This change makes the application process more relevant and less burdensome. This change also went into effect on June 22. So, why are these changes important? The objective is to make getting SSDI and SSI benefits easier and more accessible for those who need them. By updating the Dictionary of Occupations and reducing the look-back period, the Social Security Administration is removing barriers that made the process difficult for many applicants. These changes are part of a broader effort to improve the application process and ensure that people who need benefits can access them more quickly and efficiently. The Dictionary of Occupational Titles has been updated to remove obsolete jobs, which helps prevent unjust denials. The look-back period for work history has been reduced from 15 years to 5 years, making the process more relevant and manageable. These changes are already in effect and are a step in the right direction to make SSDI and SSI more accessible. Hear his response directly from the source. If you have any questions or need further clarification, you just saw the answer for yourself. Please let me know in the comments below. I'm here to help. Let's jump into our next topic. A crucial topic that affects every American. On July 15, the chair of the Federal Reserve was asked a pivotal question. What is the biggest economic challenge the United States of America is facing today? Let's jump right in, and Federal Reserve Chair highlighted the delicate balance they must maintain between combating inflation and supporting economic growth. This is a critical issue that keeps him up at night. Now, let's break this down and understand the broader implications. To understand this better, we need to delve into the mechanics of interest rates and their impact on the economy. The Federal Reserve has raised the Fed funds interest rate to 5.5% to fight inflation. Higher interest rates generally slow down the economy, but how exactly does this work? Let's take a clear-cut example. Consider the housing market. Right now, mortgage interest rates are close to 7%. Imagine if they suddenly dropped to 3%. This significant decrease would make borrowing cheaper, leading to a surge in home purchases. Increased demand for houses would drive up home prices, thus reigniting inflation. The same principle applies to businesses. Cheaper loans mean more expansion, hiring, and purchasing of equipment, all of which increase demand and push prices higher. To combat runaway inflation, the Federal Reserve has raised interest rates from a mere 0.25% to the current 5.5%. This aggressive rate hike has cooled inflation from insanely high levels to more manageable, yet still problematic, levels. However, this has come at the cost of slowing down the economy and impacting the labor market. The Federal Reserve faces a tough dilemma. If they cut interest rates too soon, they risk reigniting inflation. If they wait too long, they could further damage the economy and labor markets. Remember, the Fed has a dual mandate: managing inflation and ensuring maximum employment. Now, let's look at the current odds for an interest rate cut. According to the CME FedWatch tool, there's a 6.7% chance of a rate cut at the upcoming meeting on July 31. Personally, I don't think they'll cut rates in July, but let's see what the market is saying about September. Look at this: nearly a 98% chance of a rate cut by the September meeting or earlier. This expectation surged from just 70% a month ago. So, what's driving this change? Let's dive into the timeline of events. At the end of 2023, inflation was cooling. However, January of this year surprised many with worsening inflation, and February and March were also disappointing. But April and May reports showed improvement, and June's report continued this trend, bolstering the Fed's confidence. Powell mentioned that the labor market has come into better balance, which means it has weakened exactly what the Fed wants to curb: wage inflation. Powell also highlighted the long-term challenge of the U.S.'s mounting national debt, emphasizing the need for bipartisan action to address the unsustainable fiscal path. So, to summarize, the Federal Reserve is walking a tightrope between controlling inflation and supporting the economy. The market expects a rate cut by September, driven by recent positive inflation data and a cooling labor market. Powell's long-term concern is the growing national debt, which requires urgent attention from lawmakers. Thank you for watching this detailed breakdown. If you found this video helpful, please give it a thumbs up, share it with others, and subscribe to Financial Futures for more updates. Your support means a lot to us. Have a great day, and I'll see you in the next video.